What if I told you the most profitable traders on Wall Street get paid even when they're wrong? Not slightly wrong, not close enough wrong, flat out called the direction completely backwards wrong, and they still collect money. Sounds impossible. Sounds like a scam, but it's not. It's the single most important thing separating smart money from everyone else. And by the end of this video, you'll understand exactly how they do it. Let's start with the uncomfortable truth. 85% of retail options traders lose money in their first year. 85%. That's not a typo. That's not cherry-picked data. That's the reality of how most people approach options. And it gets worse. A study from the London Business School found that between 2019 and 2021, retail traders lost over $2 billion in options premium. $2 billion. Not in stocks, just in options. Why? Because retail traders are trained to do one thing: predict direction. Call it up, put it down, pick a side, and pray. That sounds logical, right? The market's going up, so I buy a call. The market's going down, so I buy a put. Simple. Except it's a losing game, and the numbers prove it. When you buy an option, 3 things need to happen for you to make money. You need to get the direction right, you need to get the timing right, and you need the move to be big enough to overcome what you paid for the option. Direction, timing, magnitude. You need all 3. Miss any one of them and you lose. Now think about that for a second. How often do you get all 3 of those right at the same time? This is why retail traders keep losing. It's not because they're stupid, it's because the game is rigged against option buyers from the start. But here's where it gets interesting, because there's a reason the game is rigged, and once you understand it, everything changes. It's called the volatility risk premium, and it is the single most important concept in options trading that nobody talks about. Here's what it means in plain English. Options are overpriced, not sometimes, not in unusual market conditions, almost always. The data goes back to 1990. Implied volatility, which is the market's prediction of how much the S&P 500 will move, exceeds realized volatility 85% of the time. 85%. Let me say that differently. The options market consistently overestimates how much the market is going to move, which means the price you pay for an option is almost always more than what the option is actually worth. Think of it like home insurance. If 10 houses in a neighborhood burn down every year, the insurance company prices their policies as if 20 houses will burn. That gap between what they charge and what they actually pay out, that's their profit. Options work the same way. The market prices options as if the S&P 500 is going to move more than it actually does. And the people who sell those overpriced options, they're the insurance company. They collect that premium gap, day after day, week after week. Since 1990, that gap has averaged about 4 volatility points, but after the 2020 crash, it expanded to over 6.5 points, some of the most profitable years in the history of premium selling. This is not a theory. This is not some YouTube guru's opinion. This is the structural edge that pension funds, hedge funds, and market makers have been exploiting for decades. And Wall Street does not advertise it, because they need someone to buy those overpriced options. That someone? Retail traders. Now, stay with me, because this is where it gets practical. You might be thinking, all right, so I should sell options, become the insurance company. Got it. But there's a problem. Selling options naked, without protection, has unlimited risk. One bad day, and you can blow up your entire account. That's not a strategy. That's Russian roulette with extra steps. This is where credit spreads change the game. A credit spread is simple. You sell an option at one strike price, and you buy a cheaper option further out as protection. You collect the difference as a credit. That credit is yours immediately. It goes into your account the moment you place the trade. And here's the key. You get paid even if you're wrong about direction. As long as the market doesn't blow through your strike price by expiration, you keep the premium. Let me show you the 3 scenarios. Scenario 1. You think the market is going up. You sell a put credit spread below the current price. The market goes up, you keep all the premium. You were right. Great. Scenario 2, The market goes sideways, doesn't move at all. You were wrong. You expected a move up and got nothing, but you still keep all the premium because the market didn't come down to your strike. Paid when wrong. Scenario 3, the market actually goes against you. It drops, but it doesn't drop far enough to reach your strike. You still keep the premium. You called the direction wrong. You still got paid. The only time you lose? If the market crashes through your strike and past your protection. That's your defined, known in advance maximum loss. 3 scenarios where you win, 1 scenario where you lose, and you know the maximum loss before you ever place the trade. This is not gambling. This is the opposite of gambling. This is the house. Now, here's where most people would stop, but there's one more piece that makes this even more powerful. Why SPX? Why not just trade options on any stock? SPX options are what institutions trade. 40% of all U.S. option notional volume every single day. Not Apple, not Tesla, not GameStop. SPX. There are 4 reasons smart money lives in SPX. First, cash settlement. When an SPX option expires, you never get assigned shares. It's cash in, cash out. No stock delivery headaches, no surprise assignments on a Friday afternoon. Second, European-style exercise. These options can only be exercised at expiration, not before. You'll never get pulled out of a position early. You set it and you know exactly when it resolves. Third, tax treatment. SPX options get the 60-40 rule under Section 1256. 60% of your profits are taxed as long-term capital gains, 40% short-term, even if you held the position for 1 day. Fourth, liquidity. Tight spreads, massive volume. You get in and out at fair prices. This matters more than most people realize because poor fills eat into your edge over hundreds of trades. This is why institutions don't trade Apple options for income. They trade SPX, and now you know why. So, let's put all this together because understanding the pieces isn't enough. You need a framework. There are 5 elements that make a credit spread strategy work consistently. Element 1, context. You need to know the market environment. Is the trend up, down, or sideways? Is volatility high or low? A credit spread in the right context has a completely different outcome than the same spread in the wrong context. This is where your chart reading actually matters. The skills you already have, they become your edge in choosing when to sell premium. Element 2, strike selection. How far out of the money do you place your short strike? Too close and you get more premium but more risk. Too far and the premium isn't worth the trade. The sweet spot depends on volatility and market conditions. This is where the data guides you, not your gut. Element 3, time decay. Every single day, the option you sold loses value. That's called theta, and it works in your favor as the seller. Time literally pays you. The option melts like an ice cube. You sold the ice cube. You want it to melt. Element 4, probability. When you sell a credit spread out of the money, probability is on your side. Backtests on SPX put credit spreads show win rates between 70 and 90%, depending on your strike selection and time frame. 70 to 90%, not 50-50, not a coin flip. The odds are structurally tilted in your favor. Element 5, defined risk. Your maximum loss is known before you enter. It's the width of the spread minus the credit you received. No surprises, no margin calls, no waking up to find your account wiped out. 5 elements: context, strikes, time, probability, risk. When you combine all 5, you don't need to predict the market. You need to position yourself so that the market has to move a lot against you before you lose. And most of the time, it doesn't. This is the shift, and I need you to really hear this. Retail traders think in terms of right or wrong. I was right about Apple. I was wrong about Tesla. It's a batting average, and they feel like failures when they don't hit above 500. Smart money doesn't think that way at all. They think in terms of expected value. They ask, over 100 trades, does this strategy make money? If the answer is yes, then any individual trade being wrong is irrelevant. It's a rounding error. It's the cost of doing business. When you sell credit spreads on SPX, you are not making a prediction. You are making a probability bet. You are saying, I don't think the market will crash 20% in the next week, and you get paid for being right about that, which you are the vast majority of the time. You go from being a gambler trying to predict every move to being an insurance company that collects premiums and pays out occasionally. That's the transformation. That's the shift from retail thinking to institutional thinking. And this is exactly what my SPX income system is built on. Not predictions, not hunches, a mechanical, repeatable process that uses credit spreads to collect premium, systematically, week after week. The market goes up, paid. Sideways, paid. Down a little, still paid. Down a lot, defined loss. Move on, do it again. So let me ask you this. If you knew there was a strategy where options are overpriced 85% of the time in your favor, where you get paid even when your directional view is wrong, where your risk is defined before you enter, where time literally works for you every day, and where the win rate is backed by decades of data, would you keep buying lottery tickets, or would you become the house? That's the question, and now you know the answer. If this changed how you think about options, do me a favor, hit subscribe, drop a comment telling me what clicked, and if you want to see how I structure these trades in real time, stick around because the next video goes deeper into the exact setup. You don't need to predict the market. You need to position yourself so that the market pays you for showing up. That's not a secret. That's just maths.